You finally did it. You scraped together your first $500. It's sitting there, a small stack of capital with immense potential, but almost immediately the anxiety sets in. The dilemma is real. If you put it in the market today, what if it crashes tomorrow? But if you leave it in a standard bank account, inflation is slowly eating your purchasing power. The financial industry wants you to believe that investing requires a complex strategy, a finance degree, or a massive bankroll to even get started. They want you confused. But the truth is, deploying your first $500 isn't about picking the right stock or timing the bottom. It's about following a sequence. It's about mechanics over magic. This is underground wealth formula, the money systems they don't teach you in school, broken down so anyone can actually use them to build a real financial future. Today in episode 6, we are breaking down the exact investing formula for beginners. We're going to show you how to move from saver to allocator. We'll show you how to allocate that first $500 to protect your downside while capturing your upside. No stock tips, no platform promotions, just the pure mechanics. Before we talk about returns, we have to talk about ruin. Step 1 of the formula is the emergency buffer. This is the floor of your entire financial house. The biggest mistake beginners make is investing money they might need next month. Life is unpredictable. Cars break down, medical bills happen, jobs change. If your $500 is in an index fund and an emergency hits during a market dip, you are forced to sell at a loss just to survive. That is exactly how wealth is destroyed. You need a counterweight, a buffer that ensures you never have to touch your long-term investments for short-term problems. This is about emotional and financial stability. If you do not have at least $500 to $1,000 sitting in a separate, easily accessible savings account, your first $500 doesn't go to the market. It goes to the buffer. Think of this as your sleep well at night fund. It is not meant to make you rich. It's not meant to outpace the market. It's meant to give you clarity. It is meant to keep you from going into debt when life happens. Once you have this foundation, you can actually afford to take calculated risks in the next steps. Keep this buffer in a high-yield savings account. It stays liquid, it stays safe, and it earns a small amount of interest while it waits to protect you. While 4 or 5% isn't going to make you a millionaire, it's far better than the 0.01% your local big bank is likely offering you. Once this buffer is fully funded, and only then, every single dollar you save from this point forward is ready to be deployed into the second tier of the formula. Step 2, the diversified vehicle. This is where your money actually goes to work. This is the engine that will drive your long-term wealth accumulation. Beginners often try to pick individual stocks, treating the market like a casino, hoping for a lucky strike. The underground formula treats the market like a machine. Individual companies can fail. CEOs can make mistakes. But the collective engine of the global economy has a multi-century track record of upward growth. You want to buy a low-cost, broadly diversified index fund or exchange-traded fund. Think of it as a basket containing tiny slices of the best companies. Instead of betting on one horse, you are betting on the entire race. If one company in the index fails, it's replaced by the next rising star automatically. But before you buy your first share, you must understand 2 critical variables that the industry often glosses over: risk tolerance and time horizon. Time horizon is simply how long you can leave this money untouched. It is the single most important factor in deciding where your $500 belongs. If you need this $500 in less than 3 years, maybe for a house down payment or a wedding, it does not belong in the volatile stock market. 3 years is not enough time to recover if the market takes a sudden 20% dip right when you need to cash out. In the short term, the market is a gamble. But if this $500 is for retirement or for a goal a decade or more away, your time horizon is long. And time is the ultimate filter for market noise. When your horizon is long, your risk tolerance can be high. You can afford to ride out the crashes because you know the historical trajectory is always up. You aren't trading, you are planting. You are buying time. And in the wealth formula, time is the multiplier that turns $500 into a fortune. Now we reach step 3. This is the secret weapon of the wealthy, and it's the most overlooked part of the formula. It's the asymmetric bet, investing in leverage. Let's be honest. When you are starting with $500, the mathematical returns of the stock market, while powerful over decades, won't change your life this year. A 10% return, which is a great year in the market, only nets you $50. That's a few dinners out. It's not wealth, it's just maintenance. If you want to accelerate your wealth, you must increase your primary income engine, you. This is the only asset you have 100% control over. Allocating a portion of this $500 to invest in a high-income skill or a tool that scales your output is the highest ROI move you can possibly make. In the beginning, your ability to earn an extra $1,000 a month through a new skill is infinitely more valuable than a 10% return on a small portfolio. This could be a certification that gets you a promotion, a course that teaches you AI-assisted freelancing, or software that automates a side hustle. The stock market builds wealth slowly through compounding. Your skills build wealth rapidly through income scaling. Once your income scales, you pour the excess into the vehicle. This creates a feedback loop. Higher skills lead to higher income, which leads to higher investments, which leads to a faster path to financial freedom. I am deliberately not telling you which specific fund to buy or which platform to use. I want you to be an allocator, not a follower. Here is your research checklist. When researching your investment vehicle, the first thing you look at is the expense ratio. This is the fee the fund manager charges you every year. A 1% fee might sound small, but over 30 years, it can eat up to 30% of your total wealth. You want this number as close to zero as possible. Look for low-cost providers. Many broad index funds now have ratios under 0.05%. That is where you want to live. Next, research the account type. If this $500 is specifically for retirement, look into tax-advantaged accounts like a Roth IRA or a traditional IRA. Tax advantages are another multiplier. If you can grow your money without the government taking a cut of the capital gains, you win much faster. Finally, ensure the platform you choose charges zero commissions on trades and zero account maintenance fees. In 2026, you should never pay a toll to invest. Do not pay someone to hold your own money. Do the research, open the account, and set up an automatic transfer from your bank. Automation is the key to habit. Your first $500 is the most important money you will ever deploy, not because it will make you rich today, but because it builds the habit of capital allocation. Once you master the sequence, buffer, then vehicle, then leverage, you aren't just a saver anymore. You are an investor. You are in control of your engine. To recap the formula, first, secure your buffer. Ensure you have that $1,000 safety net so life can't knock you off your path. Second, buy the diversified vehicle. Stop picking stocks and start buying the economy. Use low-cost index funds to capture the market's long-term growth. And third, invest in your own leverage. Use your capital to gain skills that increase your primary income. This is the ultimate wealth accelerator. Now, I want to hear from you. Where is your first $500 going to go? Are you building the buffer today, or are you ready for the vehicle? Drop a lock emoji in the comments if you're committing to the sequence. Let us know your move. We read every single one. Unlock the next formula. Subscribe so you don't miss episode 7, where we dive deep into the leverage tier. This is Underground Wealth Formula. Information is leverage, but execution is wealth. See you in the next unlock.